Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment and property management expert Kyle Stephonson. Now, Kyle is the president and owner of KRS Holdings, a real estate investment and property management firm that manages more than 4,000 units across the Commonwealth of Virginia. Kyle's primary focus on the investment side of his business has always been to generate cash flow with a secondary focus on long-term appreciation. His investment philosophy is to hold real estate investments through at least one economic cycle. And so, guys, I'm excited to get onto the show with Kyle. But before we do, have a few quick housekeeping items to run through. Just a reminder here, first and foremost, to go grab a free copy of my recently released best-selling book called The Cash Flow Investor, How to Create Financial Freedom Investing in Commercial Real Estate. You can either go spend $20, buy it on Amazon, or you can go to kevinbupp.com/free book and grab yourself a free download there. Again, kevinbupp.com/free book to grab a free copy. Moving on here. Guys, we still have a couple spots available in our current offering, which is the SEI Growth and Income Fund 3. We currently have more than $20 million of sweat equity that we built up in the current assets that are inside that fund. And we've got some phenomenal deals in the pipeline that we're going to be closing here over the next 30 to 60 days. And just a reminder that 2022 is the last year that you'll be able to realize 100% of the bonus depreciation benefits before that incentive kind of starts scaling back over the next couple of years. And so again, we got a couple of spots available in our current fund, have some great opportunities already in there that are passing out quarterly distributions. And then ultimately a number of other deals that are actually going to be closing here in the next 30 or 60 days. So you get to participate in all the above and be very diversified across the board. And so with that, guys, that's all I have. So let's welcome our guest for today's show, Kyle Stephonson. Kyle, how you doing today?
I'm doing terrific, Kevin. You got me excited right out of the box because on my whiteboard to the right here, I actually have bonus depreciation is your friend.
Yep.
And so I am just super excited in the fourth quarter to take advantage of bonus depreciation and spend cash and take advantage of an opportunity that may not occur again.
I agree. It's been a great run for these last couple of years, and it's it's not going to be completely away next year. I think it goes back to 80 and then 60. And I forget what the entire scale
You're
looks
right.
like
It's a
as it
phase
goes
out.
away. But no, it's been a beautiful thing. And so, Kyle, with all that being said, I gave you the brief introduction there, but I know there's a little bit more to your background and your story. So why don't you do us a favor and take a few moments and tell us a little bit more about yourself? Maybe, kind of how you got your start, how you found your way into real estate, and ultimately what it is you guys do today.
Sure. So the 3-minute life story is I am originally from New Jersey. So center of the universe for people who are from New Jersey. Ended up uh, very lucky to attend the University of Pennsylvania. While I was there, gentleman that people have heard of, Donald Trump, was really in the news, and so this is the late 80s, early 90s. And his picture was up on the wall. He wasn't there, but his picture was up on the wall. And so um, I was very inspired by a guy who was like, wow, if this guy, when you're in your 20s, if this guy can do it, why can't I? You're just going to work and grind it out. I did not realize at the time that Fred Trump, his father, started him off with about 250 million. I didn't have that type of backing, so I had to learn how to acquire real estate and really leverage in the beginning. So I would literally read books by like Robert Allen, No Money Down, and I would just get really excited because that's what you can do when you're in your early 20s. And I ended up buying my first piece of property at 142 Patterson Avenue, Patterson, New Jersey, a little duplex. And that was right out of school, and did everything I could possibly do wrong. I paid too much money, rented to the wrong people, but I really did have this love for real estate. So the beautiful thing also when you're in your 20s is you have time on your side. So
Mm-hmm.
rents go up, you pay down your note. I learned about several years later 1031 tax exchanges, and we began to tax exchange into larger properties. And I also relocated to Richmond, Virginia, where I am now. and started buying more properties. Um, After about 10 years in the business, I had a guy that I had gone to school with say, "Hey, Kyle, you're doing okay. I'd like to invest with you." I was very nervous about that. And so he actually taught me about preferred return syndications. You read about it and you learn all about it when you're in school, but it's a little different when you're doing it for friends and family.
Mm-hmm.
So we started doing 1031 tax exchanges, and um, we've been very fortunate. I do have a sound approach, at least I believe it's sound, and so we buy things that aren't necessarily the most sexy things in the world, and we fix them up and rent them out to individuals that work hard for a
Mm-hmm.
living and want clean, safe, affordable housing. So that has been my run, and through the just the wonders, I call it, of compounding interest and appreciation. Um, we've been very fortunate that we have equity in over 1,000 units, and then we third party manage 4,000 units. So
Okay.
that's really my life story.
Okay, fantastic. I appreciate that, and I appreciate you sharing. And from reading your bio on your website, it seemed like you did a stint after college. You actually got a corporate job for a period of time. Is that correct?
I did. So I
Okay.
worked, so right out of school, I worked actually selling toilet paper. So and it wasn't anything, again, nothing for Scott Paper Company. And then I left that and got into medical device sales. And
Okay.
so I spent really my mornings and afternoons in the operating room and the selling medical devices, and then in the evenings I would focus on really my other passion. I enjoyed the medical business, but
Hmm.
my passion, my love was real estate. And so in 2007, I believe, is when I left the medical industry and then pursued real estate full time
Okay. I
right
love.
before 2008 and 9.
Okay, yeah. So we're gonna dive into that, but I'd love to hear about the progression. Obviously, medical device sales. You were a high income earner. Assuming that you did well, you were in the field for a number of years, so you probably, you made six figures. Probably greater than six figures, and ultimately, were you? The plan was you always had the plan to parlay that W-2 income into real estate investments. And was part of the plan always to replace that W-2 income so that you could do this full time, do real estate investment full time?
Oh, Kevin, this is great. I get excited. I just so yeah, so I really really enjoyed corporate sales or medical sales, and I didn't suck at it. So yes, I made a good income. Um I know that I wanted to accumulate real estate. I will tell you that I also, though, had a fear, um, a really, really bad fear of failure, a fear that I still fight even now, right? So you want to make sure that you don't make mistakes that cripple you. So I thought that I would have multiple streams of income. Um, but in working with a business coach around 2005, 2006, the message that he provided is don't be a jack of all trades. Be really, really, really good at what you do. And the only way you can do that is focus and just really entrench yourself into your
Mm-hmm.
passion, into your love. And so it was a very difficult decision because you're fearful that suppose I make a mistake, my world is going to implode. And so it was a difficult decision, but when I made it, um, I was all in, and that was my decision. I'm all in. I'm going to be the best I can possibly be at investing in residential real estate, and I'm not going to look back.
Were you you owned your own properties at that point in time, but were you actually already doing third party management as well, or was that something new that you got into?
So yeah, great question. The third party management came as a result of some really tough times. Can I talk a little bit about that? Is that okay?
Absolutely.
Okay. So anyone that is, I don't know what the age, anyone that was working in the 2008, 2009 time period can remember it was a really tough recession and you couldn't borrow money. Banks would not lend you money. You couldn't borrow money for a stick of gum. So I was a salesperson. That was my background. And we were doing okay, but I needed more properties because I had created some infrastructure to
Mm-hmm.
do deals that I couldn't do because everything fell apart. So I would go to lenders and I would say, Mr. Lender, I know that you have some bad debts, some stinky debts on you, bad credit. We call them non-accrual assets is what they call them, or special assets. I know that you may have some of those on your books. Um, I think I can help some of your clients get current, which would be huge for these lenders, right? Because the lenders then all they want is their mortgage payment
That's
paid.
it.
They don't want to take the property back. So they would introduce me to their clients, and I would sit down and maybe come up with a plan that worked well for the lender and um, for the borrower.
A
And
property management plan, not necessarily trying to come up with a restructure of the debt. Was it more just on the operation side is what you
You
were trying
you
to?
got it.
Okay.
You
Okay.
got it. So for example, there could be a 4-unit building that the bank hadn't been paid a note for a year. And there could be a couple of reasons. One, well, it's mismanagement. No matter what, it was mismanagement of the asset. It could have been mishandling of rent coming in, or it could be that the individuals weren't paying rent, so you had to get them out. It could have been, a maintenance issue. So we would take care of all of that. We would manage it, and then we could send rent proceeds or whatever the cash that's left over to the bank. And it may have been a year, it may have been 2 years, but we could get a lot of assets current. That allowed me to develop really long-standing relationships with a lot of these lenders because we got them out of a jam.
Mm-hmm.
And so every day I would call on different lenders. And that's how we ended up starting to do third party management. Admittedly, Kevin, I didn't feel this is probably you'd be like, man, dude, you're worried about failure. And I wasn't confident enough in my ability to manage property for others until I started dealing with what I'll call the train wrecks of
Yeah.
so I even though I was managing okay for myself, I was so worried that
Mm-hmm.
um I wouldn't do right by a retired couple that needed that income to survive because I didn't feel like I had learned enough about heartache and problems. And so
Mm-hmm.
it wasn't until I went through the recession dealing with lenders that I was like, you know what? I can do this for anybody. I have seen it
Yeah.
all. I feel fully confident. So that's how I ended up starting really pushing the third party stuff. Um, and so that was probably 2011, 12, somewhere around there when I started to feel that I had the confidence that my firm could handle that.
Yeah, no, that's fantastic. I appreciate that insight there. I mean, it sounded like maybe you got pushed into a corner and ultimately found your way out of, fought your way out of it, and really it flourished into a vibrant business. Something maybe even greater than that of what you had envisioned back then, which is a beautiful thing. So that's absolutely incredible. And so, talk to me about maybe some of the lessons that you learned. Again, there's a mixture of folks that listen to the show. A lot of just passive investors that are LPs in deals that don't deal with any of the day to day, and then on the other side of the equation, there's maybe some larger syndicators that still outsource their management and just handle asset management. But then there's plenty of others that actually have their own deals. They manage their own deals. They're in their own trenches, dealing with the fires on a day-to-day basis. And so, talk to me about some of those, just working through those challenging assets. You obviously learned what properties maybe to stay away from, what neighborhood to stay away from, or how to deal with like a troubled tenant. Just help me understand some of like the biggest takeaways from that period of time of just really cutting your teeth on some of the most challenging assets.
So, that boy, that's interesting. So one of the things that we've learned is underwriting that tenant is so critical. And one of the things when individuals have trouble sometimes managing assets is they know they have debt service they need to meet. They have this mortgage payment. And sometimes we're motivated, or individuals, a property management company is motivated to lease that property out to generate cash for that owner. However, the individuals with that don't underwrite well, whether it's landlord tenant issues or uh, a low FICO score, where we know better. We know that that individual, history tells us that if, less than a 600 FICO score, you're going to have a more than 50% chance of default. Why are we, renting to that person? Well, maybe we underwrote the deal at $100 more a month than really what the rents are, $200 more. And so then we settle for a bad credit tenant because
Mhm.
that tenant needs housing. You have housing above market. And then if it's a multifamily deal, it may unravel. It may be that now that tenant who may not be working or just has trouble making making their rent payments. Now you have, I call it carbon paper plastered all over your doors, and then the cash, while you did okay the first month, you begin to unravel because those individuals don't have the ability to pay you on a timely basis month after month. As a matter of fact, right, they have a proven track record of not being able to pay their rent. It's or any other bill. And so I would say that um, uh, what we've learned and what we try to preach to all of our clients is, make sure that you charge that fair market rent. Okay. Don't go above fair market. Um, and that you underwrite, even if it takes a little bit longer. Don't sacrifice for a bad tenant, especially in the current economic conditions where you may have courts that are ridiculously tenant friendly and you're literally sitting around, for several months. You can't get this person out because you settled. Don't compromise on your underwriting. So I would say that that's one huge thing that we've learned.
So what are so when you're screening an individual tenant, you mentioned anything less than a 600 credit score, there's a 50% chance of default of that prospective resident. What are some of the other big red flags? Obviously, an eviction or recent auto repossession, like I feel like those are two major red flags, but what are some of the other telltale signs that like they're just going to be a challenging resident, probably not a good fit for the property?
Yeah. So depending on the ability of your credit research, landlord tenant, not just evictions, but if you've been to court for anything with your landlord, it could be that you were late and you're going to court and they're not filing. It's not eviction; it's just a collections issue. Anything like that. Um, for us, we look at as a non-negotiable. That's where you
Mhm.
get into, again, the 50% default rates. You don't want to do that. And the labor it takes for you to work with these individuals is unbelievable, right? The
Mhm.
headache. So I would say the number one thing that we look at is landlord tenant matters. Repos, no question about it. The
Mhm.
one thing that surprisingly we have not found a relationship with is whether you've had a bankruptcy or not. So
Mhm.
we're okay with individuals that their bankruptcies are settled, that they're not in the midst of bankruptcy, but the bankruptcy has settled. So as a matter of fact, we've seen those individuals. There may be an inverse relationship in lease compliance. That if you have somebody with a higher FICO score that has had a bankruptcy, you'll see a higher level of lease compliance. So that would be something that some people wouldn't appreciate. So I find that pretty interesting. One of the things that we will discount a little bit are medical collections. Medical collections can be very overwhelming, and so we don't necessarily put a lot of weight behind medical collections.
I agree. Our healthcare system is a mess, and so it just it seems that even folks that have health insurance sometimes end up with a medical collection that they didn't even realize they had. So
that's right. That's right. That's right. That's right.
So talk to me about one of the comments when I was making your introduction. I read on your bio was that one of your investment philosophies is that you hold assets, and so that's on the investment side, not the property management side per se, but you hold assets through one entire economic cycle. Talk to me about that, and just is that firm and true on every asset that you buy, or are there exceptions to that?
Ooh, great question. So I'm not sure, I'm sure there are assets that I have purchased that I've sold within in a few years. So I need to kind of digest that. But I think, what we like to do, we like to buy assets that we can reposition, take advantage of depreciation, right, to offset cash. So you're getting in your first several years, and depending on, you can do cost segs as well. All right, but that we're going to be able to take advantage of depreciation to offset cash that we're going to collect. All right, so we're getting fairly healthy returns even in this market. And then that economic cycle, if it's 10 years, if you cost seg it, you're giving you about 85% of your depreciation is used up. And the other part is that, the boom is where you get what I call disproportionate appreciation. So we're looking for all of the advantages of real estate in the beginning of the cycle, well, in the entire cycle. We want to take advantage of all of the benefits of real estate. So we get to realize some cash. We realize the depreciation to offset the cash. And then we realize what I again define as disproportionate appreciation on the back end. And then we either sell, or in some cases we've 1031 into another attractive asset. So that is why we wait an entire cycle. We're not in the business of just buying for appreciation. We again want to make sure that asset is managed well to throw off cash, and then I said it already, to offset the cash with the depreciation.
Are you seeing any slight adjustments in the, I guess let's speak to your local marketplace. Any price adjustments, seller expectations shifts, today versus what it looked like maybe 3 or 4 months ago? Again, most of it related to just the capital markets and interest rate volatility and things of that nature. Have you seen any changes occur as of recent?
Yes. Over the past, really from the beginning of this year, in some cases, I'll share with you, this is just crazy. I'm part of a partnership that we refinanced using HUD financing on a 35-year AM in February. I think it was February, could have been January. We secured financing at 2.3%. So there are clear lenders that are actually not as excited about any sort of spec work. We don't do a lot of speculative work, but they're not interested in lending on that. They're looking for higher loan to values, where someone may do an 80% LTV on an acquisition. They're now at 75%. We are seeing some, what I would say is that deals aren't happening or they're getting retraded at this point. Um,
Have you seen any of your clients? Obviously, you have a lot of clients that are investors. Any of them that have just kind of put the brakes on or just stepped onto the sidelines that were actively buying, maybe last year that have slowed down a lot this year?
yes. And in addition to that, we have clients that had IO notes
Mm-hmm.
that are now going and requesting extended IO terms from their lenders. And I believe the reason they're doing that is they may have modeled something with 20 to 30% rent increases year after year. And it's just kind of hard to
Yes.
really do that. And so we are, there's no question about it that um that the tide is starting to go back out.
Mm-hmm.
And it'll be interesting over the next year to 2 years what that means. It's my understanding just through some of my contacts, some of my relationships, that that there are going to be a lot of variable rate notes that will reset next year. And that may get a little uncomfortable if you have a
Mm-hmm.
deal that was already skinny on debt service coverage.
Mm-hmm.
And then there's no slow up on the expense side yet. As a matter of fact, real estate taxes in Richmond, Virginia were up like 20%. I don't know what the exact number was, but you can round it to 20%. That's a little bit uncomfortable. So there's some headwinds for sure. Um, uh, starting to hit the market.
Okay. Yeah, no, I appreciate that feedback. And where does that put you, like on the investment side? Talk to me about finding deals, and again, we find ourselves in a strange part of the market. I mean, looking back 6 to 8 months, hyper competitive, and now there's still a lot of capital flowing around, a lot of capital that needs a home, but ultimately just we're kind of in like this no man land territory. And so, are you still finding opportunities? Are you still buying deals yourself? If so, what are you doing? Are you doing anything outside the norm strategically to continue to find opportunities that make sense?
So we are being patient. I am still finding some deals. It's difficult. It's been very difficult over the past year.
Mm-hmm.
We've had some individuals. It's funny. I have a sticky um, on my desk here on someone that we had made an offer to, um, gosh, a few months ago, and I guess they just left me a voicemail. Um, we couldn't come to it just didn't work for both of us at that, a few months ago. I know I think I know why they're reaching back out to me, but the difference is that the markets have moved about 150 bips. So the price that I had a few months ago was based off of a different interest rate environment. So we'll see how this
Yeah.
conversation goes. But are we doing anything differently? Not really. I think the one piece we deal that we were doing, we were pretty firm. The seller had a certain price in mind, and um, I had a different price in mind,
Hmm.
and they came back and they were like, "Hey, would consider you know our price maybe times 0.95?" And I was like, "No, I'm kind of where I thought we were." So I think we're a little bit firmer on price, but we're not. I think again we just have this model that we're going to look at mismanaged stuff, or
Yeah.
yeah, and so we're going to be patient. And you're right, there's a lot of capital chasing deals. Um, we may start to inquire from some of our investors what their appetite may be for a
Mhm.
fund in 2024, and what we think we would buy with that fund. But
Sure.
we're still, a little bit cautious.
Yeah. No, that makes sense. As are we. So no, I
Yeah.
appreciate the feedback there. Kyle, this has been a very insightful conversation. Really appreciate you coming on here today. For those that want to learn more about you and your team and what you guys have going on, where's the best place to find you?
So the website is krsholdings.com, and I think my email is still on the site, so they can feel free to email me directly. You just look at my picture and press the button there, and it'll
Right.
and so send me an email, and I'll be sure to respond.
Okay, fantastic. Well, Kyle, it's been a lot of fun having you here today. I appreciate you joining us.
Thank you so much. Best
Already
to
got,
you, Kevin.
yeah, thank you. Guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bob, wishing you huge success. Take care now.